Welcome back to the deep dive. Today we're jumping straight into the numbers, specifically the 9-month 2025 reports for CarrefourSA.
That's Carrefour, Sabancı, Takara, Merkezi S.
Right. And our goal here is pretty simple. Cut through the jargon and pull out what you, the individual investor, really need to know.
It's a key player.
Definitely. And if this analysis helps you out, saves you some time, please do hit that like button, subscribe, and maybe share it with someone else trying to figure out the market.
Okay, so CarrefourSA, they're obviously big in the Turkish hypermarket and supermarket game.
Based out of Istanbul.
And the ownership structure is important here.
It is. You've got CarrefourSA holding with a majority stake, 57.12%, and then Carrefour Nederland BV holding about 32.16%. Strong backing.
Now, looking at operations, there's been a significant shift, hasn't there? They seem to be making a big pivot.
Yeah, look at the store count. They ended September 2025 with 12,219 stores. But the mix is changing.
How so?
Well, 609 of those are now franchises. That's over half. They seem to be aggressively expanding using that model. And that ties into the staffing numbers too, right?
Yeah.
Headcount's down.
Exactly. Dropped from over 10,600 down to just under 9,600. That suggests they're maybe shifting labor costs out while trying to grow their footprint via franchising.
It looks like their new generation market strategy in action, aiming for leadership.
It does, but it's interesting what isn't happening alongside that growth.
Like what?
Well, governance-wise, it's a 12-member board, but only one woman, Sakin Shibnam Under.
Okay.
And perhaps more telling for the strategy, zero reported investment in R&D for the first 9 months of 2025.
Zero R&D. So it's all focused on immediate market grab, not long-term innovation.
Seems that way. Pure execution, immediate expansion. On the ethics side, though, it's good to note no loans or guarantees went to the board or top execs, pay determined by the General Assembly.
All right, let's connect this strategy to the financials, because this is where things get, well, complicated. Top-line revenue first.
Okay.
It actually dipped slightly from about 61.2 billion Turkish lira in the first 9 months of 2024 down to 60.4 billion this year.
Right, a small decrease. But here's the fascinating part. Despite that dip, their gross profit margin actually ticked up a little.
Really? How much?
Went from 23.17% to 23.49%. It suggests the core retail operation got slightly more efficient at turning sales into gross profit.
Okay, a small gain in operational efficiency there. But that gain seems completely overwhelmed elsewhere. The bottom line looks pretty bad.
It does. The net loss more than doubled. We're talking a loss of 4.7 billion lira in these 9 months compared to a 2.24 billion loss last year.
Wow. So what's dragging it down so hard if gross margin improved?
It's the cost of financing that growth. Financial expenses absolutely ballooned.
How much are we talking?
They jumped from roughly 3.8 billion lira last year to over 5.8 billion lira this year. That's huge.
And that's driven by borrowing for the expansion.
Precisely. They took on significant new short-term debt, issued bonds like that 2.6 billion lira bond back in July. They're paying a very high price for the cash needed to fuel this franchise rollout and store activity.
And this borrowing, this cost of debt, it's hammering the balance sheet. Let's look at liquidity.
Yeah, it's not pretty. The current ratio, that measure of short-term assets versus short-term liabilities, fell from 0.61 down to 0.50.
0.50. So for every lira of short-term assets, they have 2 lira of short-term debt.
Essentially, yes. Their short-term liabilities exceed their current assets by over 15 billion lira. That signals a serious working capital crunch.
That's already alarming. But the leverage picture, the debt-to-equity ratio, that's the real shocker here.
It is. I mean, it didn't just rise, it completely exploded.
Give us that number again.
Okay, get ready. At the end of 2024, it was 5.23. As of September 30th, 2025, 60.33.
60.33. That can't be right.
It is. 60.33. It's staggering. And it reflects the near total collapse of shareholder equity.
How much did equity drop?
From 5.5 billion lira down to just 571 million lira. The debt load and losses basically wiped out the equity base.
So let's put that 60.33 number in perspective for you, the listener. It means for every 1 lira of shareholder capital left in the company, there are over 60 lira of debt piled on top. That's extreme financial distress territory.
Absolutely. And while they did manage to slightly reduce the cash burned in operations compared to last year, down to about 692 million from 1.2 billion burn, they are completely reliant on raising more debt just to keep going.
So the core conflict is stark. Tiny improvements in how they sell goods, completely swamped by massive financing costs that have just obliterated the net results and shareholder equity.
That's picture.
Yet, despite all this, they're still investing, aren't they? Plowing money into assets.
Yeah, nearly a billion lira, 906 million, roughly invested in tangible fixed assets during the period. The expansion bet is still on.
Which brings us to the final thought.
Right. For any investor looking at this, the critical question is unavoidable. They've massively scaled the franchise network, invested heavily, but saddled themselves with crushing debt and are bleeding cash on the bottom line.
So the gamble is,
Can this aggressive expansion generate enough operational profit quickly enough to start covering those enormous rising finance costs and begin repairing that disastrous 60-to-1 leveraged balance sheet in 2026? Or will the debt load simply prove too much? That's the multi-billion lira question.